Hello everyone. Today we will look at a particular area from paper P3, a bit of a non-conventional area which occasionally does get tested, time series and regression analysis. Whilst this is largely management accounting and should be part of F5 or say P5, uh, it's been included in P3 to ensure all candidates doing ACCA exams, even those who are exempted from paper F5, do pick up these skills that may be essential for an accountant. Let's use the question from December 2013. The name of the question is ATD, and in case you're using a Kaplan revision kit, this should be question 10 in the 2014-15 edition. In any case, this is question number 2 of December 2013. I presume before you watch this video, you'd sit down and read through the question. So I'm going to get straight into the requirement of the question. The first part of the requirement there wants you to explain and analyze the data in the least squares regression and time series analysis spreadsheets, figures 1 and 2 left by the business analyst. You are also asked to evaluate the appropriateness of both these techniques, namely least square regression and time series, for sales forecasting at ATD. And this is the part that we're going to look at today. There's a little bit there on budgeting, which yet again is largely sort of knowing your stuff and being able to relate to the specific problems here and how budgeting will help those problems. But today we'll particularly look at part A of the question. Now, in a question like this, that's worth 15 marks. I know you must add value in your answer and put in enough points for the available marks. Now, how do you do that? Well, most of these questions tend to have a significant number of marks for the first part, which is to explain the answer. And a large part of explanation is talking about how these numbers have been derived and what these things, what the end outcomes or the output from these models mean. And in this question, if you do look at the examiner's marking scheme, there are 10 marks out of 15 for just doing that. And then for evaluating how appropriate these techniques are to sales forecasting. I know this is very unconventional or non-conventional on P3 to have a bit of numbers, but then you're rarely asked to compute anything. It's more of talking about it. Now let's look at the purpose of least squares analysis or regression analysis. I've just put the numbers into a Excel sheet here, which will help us understand the model better. We just keyed in the data there. What do we have there? We have data on the quarterly sales for the 4 years from 2010 to 2013. You've given data for 14 quarters there. And you also have the sales values given to you. Now, what we are trying to establish here, whenever we are studying sales against time, is we're trying to understand whether sales and time are related, what's the relationship between time and sales, and how strong is that relationship. We compute the strength of the relationship using what we call the correlation coefficient. Now, what has been done here rather is time has been assumed to be the independent variable x. Sales is the dependent variable which depends on time, and using the formula for regression analysis to calculate B and A. B stands for, in mathematical terms, well, you probably don't really need to get into those technicalities, but B represents the slope of a line and A represents the intercept. And as far as we are concerned, all we have to say is there's a formula to compute A and B, and when what is it that goes into the formula? You have n, which represents the number of sets of data you have, x, as you know, the independent variable, which here is time, and y, which is the dependent variable, which is sales. We put this into this formula. There's x squared there, and there's sigma x, which means sum of all the x values squared. You put that into a formula, and what they've then done is calculated the value of b as 1.84. Now, what does 1.84 mean? Well, I'll tell you in a minute after we look at how A is computed. There's a similar formula for A there. We take the sum of y B, which we've computed here, is 1.84. Put that into that formula, and there we go. We have a value of A. Now, what does this mean? What do A and B stand for? Yes, we did say intercept and the slope, but effectively, once you've got these numbers, we put this into a mathematical equation for a line wherein we are able to predict sales. Remember, y is sales based on A and B, and mathematically a line is represented by uh, as y is equal to A plus B multiplied by x. Now what we want is a relationship between X and Y, between time and sales. So we know the value of A, so we can very well say sales is 125.02 plus 1.84x, where X represents the quarter number. Now probably it begins to make a little bit of sense. What this means is as time increases, every quarter you're expecting an average sort of sales increase of about 1.84. If time is 0, you have a sale 125.02. As time passes, as the number of quarters increase, the sales is going to increase by 1.84. Further, what's been done is there's a little bit at the end of the question there, which where they say R is 0.253. Now, what is R? R represents the strength of the relationship. Strength of the relationship between the variable sales and time. And this number, please bear in mind, lies between -1 and +1. So if you compute the value of R and get a value of, say, 2.56, you can be absolutely certain that's not right. And you need to probably look at your calculations. Again, not that you'll be asked to calculate, but the value of R has to lie between -1 and +1. Now, if it is close to +1, it indicates a very strong relationship between the two variables. If it is -1, yet again a strong relationship. The only difference being here you have a negatively correlated relationship, meaning if one variable goes up, the other goes down. Something like price and quantity. Whereas when you have a positive correlation close to 1, it indicates as a very, very strong relationship. When one variable moves up, the other will move up as well. What if the value of R is close to 0? Well, if it is close to 0, it just indicates that the relationship that you have there is very weak, which means you really can't predict, one variable based on the other. And here, just to summarize the method, or rather what we're trying to achieve, we're trying to establish the strength of the relationship using this particular formula you see there, which has been calculated as 0.252. Now, although not there in the question, for your info, if you take the value of R and square it, if you do square the value of R, you get what we call the coefficient of determination, which in this case comes out to 6%. What this means is only 6% of the change in sales is explained by change in time. In other words, 94% of the changes in sales are due to factors which are other than time. Now, we've spoken about sort of regression analysis and sort of calculating correlation coefficient. And you just need to sort of explain the process and what you're trying to achieve. In terms of limitations, I know we wanted to do that right at the end, but let's just, since we've just gone through this, what are the limitations of this model if you're using it for forecasting at ATD? One of the limitations that you would see straight away is that the value of R is very, very small, close to 0, which means there's a weak relationship. You really can't rely on this model to predict sales based on time. Your estimates may not be accurate, will be very far from accurate, because there are a large number of factors other than sales that would affect the rather a large number of factors other than time that would affect sales in this particular company, and hence probably there's very limited use for this approach, regression and correlation, at ATD. And that's largely probably because, when you look at the trends, we're doing trends on a quarterly basis, and as you can see, there's probably a lot of variation there between the quarters, and as a result, this particular model doesn't really take into account the fact that there are variations uh, within a year between the different seasons. It doesn't take into account the seasonal variation, and hence this model looks largely inappropriate and wouldn't give you very accurate answers. I think it's more than enough, to gain the available marks with respect to regression and correlation, explaining the idea and then talking about few reasons why it may or may not be appropriate. We then look at the next model there, which is in the question. They want you to explain time series analysis. Uh, what is time series analysis? It's a technique, a statistical technique, wherein we try to establish the trend, meaning the general movement, which is what the previous method helped you do as well. But more importantly, you also go on to estimate seasonal variations, as in variations within a given year. Now, how do you go about doing it? We need to explain the calculations here. The 5 marks for showing how this is done. Now, from the face of the question paper, it's hard to really find out how these numbers have been derived. So we put this into a calculation, into an Excel sheet here, where all the data elements have been laid down here. Now, how have they got to 131? And this is where you need to add value, you need to explain. We are all aware that in a year, there are 4 quarters. What we do is we know that the seasonal variations are within a given year. And we want to eliminate that and separate the seasonal variation from the trend or the general movement. So what we do is we start adding up 4 values at a time. Now you will appreciate when I add 4 quarters together, put together, there's not going to be any seasonal variation. So we are largely eliminating the seasonal variation there because we add up quarter 1, 2, 3, 4, the variations are within. So the first step that's done is to add 4 quarter values and put them right in the middle. For example, for quarters 1, 2, 3, and 4 of 2010, when we add them up, it comes to 521. And similarly, when you go one step down, you leave out quarter 1 of 2010, add the remaining 4 values. And this way, you've got a 4 quarter total that comes right through. We appreciate that right at the ends of data, for the first 2 elements, there's probably nothing you can do, or towards the end, you can't do 4 quarter totals there, but we do it based on whatever data is available. Then if you observe, you've got a value there between 2 numbers, because you've taken 4 quarters. Where do you put it? You put it between the second and the third value. But that doesn't help, which is why we then go in for a centered total. A centered total is nothing but adding up 2 of the 4 quarter totals. So when you add up the value there, 521 and 527, you get a value that's centered against quarter 3. And that's done. That's the case there as well. So you add quarter 3 and 4, rather, value below quarter 3 and 4, that gives you a 4 quarter centered total. And this way, what you've done is you've added 4 and 4, 8 values together into a centered total. And you want to obviously take an average. How do you then take an average? Divide the centered total by 8. Now observe, guys, what you've achieved is you had a number there in quarter 3 of 155, which was driven by not just the general trend, but also seasonal variation. Whereas here, you've got a number where the trend is eliminated. You've removed the trend because you've added up 4 quarters and averaged it out. This method is called moving averages. And if you observe now, if you keep doing that for all the values, you get the values that they've given you in the question. Now, once the trend value is established, we now know that there is a difference between what the actual sales was and what the trend was. And this difference that you see there between the actual sales and the trend represents something other than the trend, which could be seasonal variation, which could be random factors affecting sales. So we calculate the variation, which is the difference between the actual sales and the expected sales, or can I say trend. Now, once you've got the variations in, what do we do next? We then want to find out, all right, out of all these variations I've had there, what is my seasonal variation? Meaning, you appreciate that many industries, some months, some quarters are better and some aren't. As a conventional example, can I just say sale of ice creams traditionally peak during the summer months and aren't great during the winter months. Yeah, so there are some quarters when the sales are higher than expectation, some where it's lower than expectation, or rather, the seasonality does have an impact on the amount that you're able to sell. And we want to estimate, all right, what's the portion of this variation that is caused by, seasonal variations, meaning it happens every year during that particular season. For this purpose, we take all of these variations, as you will see 24 there, into a small little working, which they've done in the question as well, right at the bottom, analysis of seasonal variation there. And we copy all these numbers. Just be careful you don't put anything into quarter 1 and 2 because you don't have the data for quarter 1 and 2. We copy it in for quarter 3 and 4 of 2010 and for whatever periods we have data for. After this, we are then able to calculate an average, meaning I've got seasonal variations for different years. We take an average of the seasonal variations for the different years. And once you take the average of seasonal variations, you get a sort of a number, an average number, which represents what you could probably use as a seasonal variation consistently across the various years. So when an average is done, as you will observe there, you get an average of negative 14.88, meaning that's the month where sales lower than expectation, positive 32.06, meaning the sales is higher than expectation, and so on. And there's one final thing that's done, which I know is a very, very fine element, but then you still have to do it. That's the way they've done it, is to take the total of the seasonal variation. And we know, guys, that within a year, you shouldn't have any seasonal variations. It's just rather outside the given year. So it's all within a year. Some quarters are better and some aren't. So when you add up the seasonal variations there, it should come out to 0. It doesn't. So you have a negative 0.69 value there. So it's a slight difference. We make sure we do it perfectly right. All right. So how do we make sure we do it perfectly right? We adjust for that as well. How do we adjust that? Well, we know, we have a negative 0.69, which we have to sort of adjust and push back and bring it to 0. We spread the 0.069 over the 4 values by adding back 0.17, which is nothing but 0.69 divided by 4. You add 0.17 or approximately 0.18 to all of these values. Yeah, so you're adding 14.88 plus 0.17. That's negative, so it becomes negative 14.7. 32.06 plus 0.17. And now there you go. If you add up these 4 values, it comes out to 0, which is what you want. So you've got the seasonal variation for each quarter. We bring that back into the question here. So we say seasonal variation for quarter 3 is 22.55. There we go. Seasonal variation for quarter 4 is negative 40.08. So there we go. We copy the seasonal variation numbers adjacent to the total variation. And now if you observe, you've got the variation there. You've calculated the seasonal variation. Any difference that exists from then on is due to random factors, due to factors that are not there every year. So you've got the seasonal variation, which is consistent, as you can see, quarter 3 and 4 in 2010, quarter 3 and 4 in 2011. Every year has the same seasonal variation, but then residual variations vary because these are due to random factors that affect sales, due to something unusual in the market, due to something unexpected in the market. And by doing this, what have we achieved? We have achieved a model where we can predict future sales incorporating seasonal variation. How do you do that? Well, you've got a trend here, haven't you? You've got a trend here. This does not include seasonal variation. Now you can put these numbers, guys, the trend numbers, not the actual sales, the trend numbers you've calculated here through regression analysis. If you put the trend numbers here, you are then able to form an equation of this sort. So for example, I'm going to try and sort of do that here. So if at all I sort of copy these trend numbers into the question here, right, from quarter 3, whatever numbers I would get there, obviously the equations for for predicting sales based on time would change. And we would suppose that we are able to predict the trend of sales based on the new equation that we'd get if we posted these numbers there. But then to add more accuracy to the estimate, we could then go and adjust those values that we are predicting based for the future. Say if you wanted to predict it for quarter 15, you just need to multiply that by 15. If you wanted to do it for quarter 16, multiply it by quarter 16. And this way you could predict the trend for the future and adjust it for seasonal variation. And hopefully you'd get a fairly accurate estimate. Now, are there any problems with using time series for predictions, for future estimates? Well, it is intended to help you predict future sales, but then if you look at this particular entity, the only few issues that may arise is that even with the residual variations, there appear to be a fair bit of residual variation there, particularly if you look at quarter 4 of 2012, a very high residual variation there, which means you can't really accurately predict sales if the residual variations are high. It's fairly okay probably in some of the quarters, but in some other quarters the values tend to be very high or very low due to random factors affecting sales. So even if you are able to do the seasonal variation and the trends right, it would still be something outside what you're able to predict. Further, although some of us might say that's rather immaterial, but worth pointing out that towards the end the residual variation there is just massive. Further, if you look at the seasonal variation there, we have calculated it as an average. But the fact remains, the seasonal variations in 2010 are very, very far away from the seasonal variations in 2012. Which means even the variations are rapidly changing over time. And can we really guarantee that these variation numbers will hold good in the subsequent years as well? Well, we don't know. Well, if it were fairly stable, it had been 35, 37, 36, something of this sort here in quarter 4, I would say the seasonal variation numbers we have estimated is far more reliable. But you're taking an average of numbers with a very sort of significant variation in the middle, taking 35 and 47 and 37 and then doing an average. Well, we don't know how accurate the seasonal variations calculated here as an average would be. I think that largely summarizes some of the key points. Now, there have been questions in the past as well, such as a question in the pilot paper of 2011, cool freeze, which you could probably go and have a look as well. And in time series, some of the other comments that the examiner makes in the sample answer there, not here, there in that question is to go on to say, when you use time series, you're giving equal weightage to all the years from 2010 to 14 or 13, you might ideally want to give more weightage to recent years rather than older years. 2010 is old data, you might say. And as a result, he suggests a way of overcoming that. Instead of using moving averages, you could do exponential smoothing, wherein you give greater weightage to closer numbers. So just pick up some of these ideas, guys. I know sometimes some of us are not really very comfortable with talking about numbers that have already been done, but as long as you look through this question and the one from pilot paper of 2011, cool freeze, and read through the answer, pick up a few ideas, I think you should be perfectly fine. For the June 2015 exams, please also make sure you look up the concept of activity-based costing, which is also probably an element that could be tested. And broadly, just to lay out the difference between absorption costing and activity-based costing. Under absorption costing, if I'm working out the cost of a product, the costs are absorbed based on time, which therefore means if one product takes less time to produce or whatever machine time, it gets lesser share of rent, electricity, heating, lighting, overheads. If one product takes less time, and if a product takes more time, irrespective of resources consumed, you would give it a higher share of cost. On the other hand, how are overheads absorbed under activity-based costing? Are absorbed based on drivers. What you do is you split up your cost into activities, and for each activity you absorb costs based on what drives costs. So it could be, say for example, you might say, I need some engineering setups done, I have an activity of delivery, I have an activity of procurement, and for each of this you say what drives the cost up. Say for procurement, the number of purchase orders maybe. For engineering, the number of setups maybe. And you break up the total overheads into several cost pools, and you absorb cost based on what drives cost, which then obviously means you have more accurate estimate of cost. You're able to take better pricing decisions. You don't sell products at a loss thinking you're making a profit. And not just that, you're also able to reduce cost because you now know what drives cost. So just go through, probably you can just do some reading on ABC by picking up an article that's there in the amongst the F5 technical articles on the ACCA website, just to familiarize yourself. And you have to appreciate that on P3, the examiner wants to test your understanding of the idea rather than whether you know how to compute. So wish you all the very best for your exams. Thank you very much.